We're good. We're good. Hello, everybody. Here we are again, another week. My name is Tony Alvarez from Keller Williams Hoover. And again, we're today with Andy Gagliano from Gagliano Mortgage. How you doing, Andy?
Hey, Tony, I'm doing well. How are you?
Can't complain. Just beautiful day here in Alabama.
Yes, indeed. One more in the books.
Yes, sir.
Yeah.
Andy, I want to talk to you today and ask you a couple questions that
Okay.
came out the other day with one of agents in my office. And a couple of my buyers that I had a couple years ago, they were asking me about mortgage insurance. And some people don't understand or don't know what mortgage insurance is and why it's applied to the loan and when it needs to be applied to the loan.
Yeah. Yeah. So, mortgage insurance is something that, well, I guess most of us don't like to pay insurance at all, do we? Until we need it. And then it's like, ooh, I'm glad I have it. So, the mortgage insurance on a loan, simply put, is the lender's insurance policy that they will be repaid any money that they, or I should say, a percentage of the money that they lose on a loan that is foreclosed on. And so I'll just walk you through an example. Again, we're going to walk back in time and pretend it's 15 years ago and somebody's buying a house for $100,000. I do this to keep my math straight in my head because I'm feeble-minded now that I'm old. So let's say they buy a house for 100,000. They get a mortgage for 95,000 or 95% of the sales price, and they pay on that loan for say 3, 4 years, and the balance is paid down to 90,000. And God forbid something happens, maybe uh, husband and wife and the primary breadwinner passes away or loses a job or is injured in an accident, and they just can't make their mortgage payment anymore. So what happens, the mortgage company eventually forecloses on that property and they're owed $90,000. And the way this is going to work is the mortgage company is going to sell that property for as much as they can, as quickly as they can. So let's say the most the mortgage company can sell that property for, because there's some deferred maintenance that needs to be done. Maybe there's a cracked foundation wall or something like that. And the most the mortgage company can sell that property for is $85,000. So they're selling it for less than what's owed. And what would happen in that case is the mortgage insurance company would step in and cover a portion of that $5,000 that the lender lost on that foreclosure. And so the benefit to the borrower in having this mortgage insurance is, well, there's a lot of people that are able to buy homes with a very low down payment because of the mortgage insurance that's charged on the loan. And so a lender, I think back to the 1940s, 50s, before mortgage insurance rolled around or was created, people used to have to put down a 20% down payment to buy a home. Well, that was a lot easier when a home cost $3,500. But now that your average sales price home's $350,000, you're talking about 20% down is $70,000, and most buyers don't have that. Coming up with a down payment is still the number one hurdle for most home buyers today. So it would be even more of a hurdle if mortgage insurance was not around to allow these lenders to take a chance and loan the borrowers more money so that they can put less down to purchase a home. So that's what mortgage insurance is. That's why it's there. It serves a great purpose in the grand scheme of real estate and mortgages. But the bad part of it is there's a monthly cost associated with it. And some mortgage insurance, there's even an upfront cost that's added back on top of the loan amount, or can be added back on top of the loan amount, that can make the payment go up even a little bit more. So obviously we don't like to pay insurance, but this is a good insurance that allows us to be able to purchase a property with not so much money out of pocket.
Correct. So that's a good thing. We always need insurance, and that is correct. But also, we don't need to confuse mortgage insurance with property insurance. That is totally two different things.
So true. Yeah, and a lot of people do get confused with that. And the other thing that people will confuse it with that I hear a lot is people will say, "Well, I'll get my own life insurance. In case I die, it'll cover the mortgage, and so I don't need the mortgage insurance." But again, that's something that's completely different as well. What they're talking about is credit life insurance, which I hate to make a blanket statement. I'm going to come very close to doing it now, and I'm going to try not to make one. I highly recommend that people do not buy credit life insurance through any of the offers they get in the mail after they purchase a home or through their lender as part of the loan process. It's much cheaper and easier, in my opinion, to get that life insurance separately through a life insurance agent. And if you guys watching don't know of a good agent to contact about that, either Tony can help you with that or I can help you with that, and we can get you pointed in the right direction of somebody that will get you a much cheaper coverage to protect your family, to pay off that mortgage should something happen to you in the future. So
That's correct.
yeah.
So with the mortgage insurance, is basically if you don't have the 20% down payment, you put 3%, you put 5%, you're going to have that mortgage insurance. Now, according to statistics, the latest statistics, I believe that over 40% of the mortgage residents are equity rich, what they call equity rich.
Right.
So meaning that their outstanding balance, the loan balance, is less than half of the home value. So they can get rid of the mortgage insurance if they have enough equity, correct?
That is correct. And so there's a couple of ways that can happen. So one of the ways that that can happen is the borrower can pay that loan balance down. And it's paid down obviously through the monthly payments that they make. And as they make those payments, that the mortgage balance comes down. But as far as the lender's purposes are concerned, the value of the home stays the same. So value stays put. Every month they make a payment, the balance goes down, and that equities that I'm signifying as the gap here between the loan balance and the property price, that equity grows. And once the loan balance gets to 78%, now this is on a conventional loan, and we'll talk about the other options here in just a minute. But on a conventional loan, once that loan balance gets to 78% of what someone paid for their home, that mortgage insurance drops off of that loan automatically. Now, Tony, you know as well as I do, we're in a unprecedented time in the housing market where home prices have just been going up and up and up and up at a record pace. And what that means is a lot of people are what you said, they're equity rich. And so what people can do in those instances is if they've not paid their mortgage balance down to where it's 78% of what they paid for their home or less, then they can petition to their mortgage lender to have that mortgage insurance dropped from their loan. The first thing the mortgage lender is going to do is look at payment history. They're going to want to see that that person has not been late on their payment over the last 24 months on their mortgage payment. And if they've not been late, then they are going to send that homeowner a letter that says, hey, you can get your mortgage insurance dropped, but you have to prove to us that the property is worth, or excuse me, that you owe 80% or less than what the property is worth. And the way you do that is you have to prove to us what the property is worth. Now,
Correct.
they already assume that the property is worth what you paid for it. Maybe that was a year ago, maybe it was 10 years ago, but they're going to assume they know what that property is worth, being what you paid for it. But if you say it's worth more, you have to prove to them that it's worth more. And there's a couple of ways that can be done. It can be done with an appraisal from an independent appraiser. It could be done with what's called a BPO, which is a broker's price opinion. And that's something that Tony can do. If Tony's, any realtor can do, I should say, if that realtor is set up with that mortgage company to do BPOs. So a realtor like Tony could do a BPO for your mortgage company. He could be on their list to do those BPOs. You would pay the fee to have that broker price opinion, that BPO done. And then Tony would pull comparables on your house, come by, take a few pictures, send that into the mortgage company, and Tony would give his recommendation of value for the property. And then at that point in time, if the value comes in high enough, the lender says, hey, we believe you. The value of the house is, or I should say the loan that's the amount that's owed on your loan is 80% or less than the value of the house. So we will drop the PMI off of your loan.
That is correct. And I'm sorry that I interrupt you on that, but with the BPO, there is something that is important to know. I personally, I approve with a couple lenders to do BPOs, but not with every lender. So a realtor can do a BPO, a broker's price opinion, but it has to be approved with that lender to be able to submit that paperwork.
That's correct. That's correct. And so, and that's a very important point. The appraiser is going to have to be approved with that lender too. And that's why you want that letter from the mortgage company saying, we will drop your mortgage insurance if you provide us with an appraisal or a BPO that's acceptable to us, showing that what you owe is 80% or less than the value of the house. And here's a list of approved providers. So don't go and just pay a realtor to do a BPO. Don't go and pay just random Joe appraiser to appraise your home. Make sure that that lender will take the BPO or the appraisal from, or make sure you order it from an accepted realtor or
that is correct.
appraiser.
Now, how long has the person who purchased the home has to wait for get that letter from the lender, you know, saying, because I understand what I have been reading and everything is, at least in the past, they have to wait 2 years or a 70% loan to value of the property. We reduce that loan 70% of the purchase when they purchase the property. So they still have to wait those 2 years?
Okay. So the short answer is yes. Okay. They would have to wait those 2 years. The long answer is this. If a buyer or a homeowner, in this case, makes a sizable equity or principal reduction payment on their mortgage, then they don't have to wait. But if they're just making the monthly payments, the lender's going to say, hey, we want to know that you can make the payments on the property before we're going to drop this PMI off of your loan. And so give us a 2-year history, make payments for 24 months if you're not making that large principal reduction payment. And then we'll, you know, then you prove the value of the house has increased enough and we'll drop the PMI for you. So,
that is correct. And that's basically work with the conventional loan. Now, can the buyer reach to the lender to confirm that they have and they would like to reduce or remove rather the mortgage insurance, or they have to wait for the lender to contact them?
Man, that's a great question. Do not wait for the lender to contact you. If you are going to have to prove the value of your home to the lender, you need to contact the lender to request the PMI to be dropped. Now, if you, the homeowner, want to wait until again, the value of the home is what you paid for it. Every month you make payments, that equity grows. If you want to wait until you owe 78% of what you paid for that home for the PMI to drop, it will drop automatically. But I don't recommend waiting.
That's correct.
I think it's worth paying, even if an appraisal costs you $600. Let's just say you're paying $60 a month for mortgage insurance. Well, that's 10 months of saving $60 a month to equal what you paid for that appraisal in order to get it dropped early. So a lot of times it makes sense to go ahead and talk to your lender, petition to your lender to have that mortgage insurance dropped from your loan.
Now, when we talk about lender, we're talking about the institution, the company that you are making the payment. We're not talking about calling Andy and telling him, hey, Andy, reduce my payment, correct?
That is true. I will say, though, I have been involved in a lot of those phone calls over the years. I'm happy to get involved. Of course, there's privacy laws that prevent me from being able just to jump in and do it for you, but we can start the process together, and then you could drop off of the call, go back to work, go back to your family, and I can wrap that call up and then follow back up with someone.
Yeah, that's correct. I mean, you can reach Andy, you can reach me if you're not sure what steps to take in order to remove that. But that is something that Andy will not do for you. He's not gonna automatically pull out of the hat and say, okay, it's being removed. Don't worry about it. But let's keep in mind something. Equity means the balance between what you own on your property, the unpaid balance of your mortgage, and the value of the property. So when you put a down payment, even if it was a 5% or 10% down payment, you already gain a percentage of equity the minute you bought that property. So it's very, very important, to get a value to that. If you believe that your property already exceeded that 20%, the value of the property for what you owe on your mortgage, then it is, you can contact whoever you're making the payment, your lender, and ask him to send you the paperwork or ask you to send you information about reducing that PMI, that mortgage insurance. Now, FHA, mortgage insurance, that's a different animal because we know when you buy FHA, it's a 3.5% down payment. Simple as that. Can FHA mortgage insurance be removed the same way that a conventional loan?
Yes and no. So
I like those dual answer. Yes and no.
Yes, yeah. Just to make matters more confusing for the consumer, there's been a lot of regulation put in place in the mortgage industry over the years that's supposed to clear things up and make things easier. And here comes the government. They're here to save us. They muddied the water really badly, I have to say. So if someone buys a home and gets an FHA loan, they are required to have mortgage insurance on that loan. However, if they put a down payment of 10% or more, then the mortgage insurance on that loan can be dropped from the loan after a period of 11 years. And so that, again, that's pretty muddy. They have to have made a 10% down payment, and then 11 years have to have rolled by, have to have passed in order for them to be able to get that mortgage insurance drop from that loan.
Regardless if you have built that equity on that home.
Regardless. Yeah, it's taxing. How about that? That's using the government and the word taxing just goes together, doesn't it? Yes, it is very much that way. And, I'm not going to get into any of the politics behind all of that because, listen, this is something that's gone through at least two administrations, two presidential administrations, maybe three. And so it's political, but it's not party politics.
Correct.
So just know that mortgage insurance is there for most people because most people are not going to buy a home with an FHA loan and put more than equal to or more than 10% down. Although we've done several of those loans over the years. So
Yeah, I've seen it. I have clients that, got an FHA loan and put more than 10% down. Now, that's one of the ways to get rid of the mortgage insurance with a FHA loan. You want to wait 11 years, more power for you. It's different, situations what we got. But the other way to get rid of the mortgage insurance is to refinance from an FHA to a conventional loan. And that means that you don't have to refinance to the whole value of the property. Let's use the 1940 numbers again, like Andy, like if you bought a $100,000 home and now that house is worth it 175. So you already built a substantial equity in it, and your loan is you owe 80% of the loan. You owe $80,000 on it. So you can refinance the $80,000, not the 175. You can leave that equity, don't touch it, just leave it there just in case, and just refinance that 80% to a conventional loan. Correct?
that is 100% correct. And we do a lot of those refinances for people. But it's one of those things where it has to make sense. And I cannot tell you how many times I've had people call me to talk about a refinance, whether it's refinancing an FHA to get away from the mortgage insurance premium or just refinancing a conventional loan, whether they're trying to get rid of the PMI or not. And I look at the numbers for them and the refinance just doesn't make sense. But a lot of times going from an FHA loan to a conventional loan, getting rid of that mortgage insurance because the equity in the property has grown substantially enough to be able to do that. And with a decrease in the interest rate and the interest savings on that loan, a lot of times that does make sense. So, there's two factors there that we have to look at when someone calls us and says, hey, I have an FHA loan, I'm thinking about refinancing. If they've got enough equity, maybe that PMI gets dropped if they go to a conventional loan, and then the interest rate drops as well. And voila, all of a sudden it does make sense for them to refinance, even though that difference in interest rate may not be that substantial. Let's say they've got a 7.5% interest rate on an FHA loan and they're able to go to a 7% conventional rate. Well, just that 0.5% difference in rate plus being able to drop that mortgage insurance from the loan can make sense. So
yeah, that can make a lot of difference. I mean, it's not necessarily bring down the interest rate, but coming from an FHA, you're getting rid of the mortgage insurance, and your payment can drop substantially, a couple $100, and on the long run, that's a lot of good savings, and you still have that equity on the home. And like this, we discussed previously, if you need to do some work in the house or you need some money, you don't have to cash out. You can get a HELOC.
That's right. That is exactly right. Very good point.
So we have options, and those options are available for you if you ask for it. Don't expect a lender to call you. Don't expect nobody to knocking on your door and letting you know, hey, these are your options to do better on your mortgage payment. And that's why you need professionals like Andy. Andy will tell you, yes, it makes sense, or no, it doesn't make sense. So, Andy, if people need to know more about removing mortgage insurance and get more general information about it, or they have any questions, how can they contact you?
Yeah, thank you, Tony. They can reach me at 205-979-4412, and I'm at extension 1. How about you?
Perfect. They can reach me at 205-370-3248. And Andy, again, thank you very much for being with us today. And this has been a great information. I hope the people that is watching us take advantage of it and look at their statement, at your payment statement, and see if they're still paying the mortgage insurance, because if they still are, it should be noted on that payment, correct?
That is true. Very true.
So let us know how we can help us. You got our numbers, and we hope to see you next week. Andy, thank you again for being with us, and I'll see you next week.
Thank you, Tony. Have a great week.
You too. Bye-bye.
Goodbye.